Silver dropped 5% in a matter of hours, not over days, not across a week of deteriorating sentiment in hours. And if you think that's just volatility, you're not watching what actually moved. The futures market absorbed the first wave. Front-month contracts shed value faster than spot could follow. Exchange-traded funds tracking physical silver lagged the sell-off by design, but when they caught up, the liquidation was visible across every major fund. Mining equities didn't wait for confirmation. They sold off in anticipation because the people trading those names understand what precedes a coordinated exit. This wasn't panic, this was positioning. The explanations given publicly were surface-level interest rate speculation, dollar strength-reduced industrial demand projections, all technically accurate. None of them explain the timing, none of them explain the speed, and none of them address what happened in the days leading up to this move. Large positions were quietly reduced, institutional exposure was trimmed, open interest in derivatives shifted before the headline ever broke. That's not reaction, that's preparation. Silver has corrected before. Sharp drops are not new, but every major correction in the past 2 decades has followed a pattern: extended rally, overextension in sentiment, and then a technical breakdown that unfolds over sessions. This one didn't follow that pattern. There was no extended rally. Sentiment was cautious, not euphoric, and the breakdown happened in a compressed window that suggests something other than natural selling to pressure. When you see that kind of move, you look at what changed structurally, not emotionally. What changed was coordination, not explicit, not announced, but visible in flow, timing, and the behavior of participants who move size. The kind of participants who don't react to news, they create the conditions under which news becomes relevant. When those players step back, the market doesn't drift lower, it gaps, and gaps don't close themselves without a reason to. Re-enter, the historical pattern matters here. In 2008, silver collapsed alongside credit markets because liquidity disappeared everywhere simultaneously. In 2013, the drop followed years of accumulation and came after central banks signaled tightening nobody believed would happen. 2020, it spiked and corrected within months as real rates turned and industrial demand projections shifted. Each of those moves had clear catalysts that played out over weeks. This one compresses that timeline into a single trading session. That compression tells you the move was not organic. So what does this mean for anyone holding silver or considering it as part of a long-term strategy? It means the narrative around precious metals is being tested right now, not by fundamentals, not by supply disruptions or demand collapse, but by the structure of the market itself and who it controls the momentum at critical moments. If you believed silver was insulated from institutional games, this should recalibrate that assumption. So if you believed physical disconnection from paper pricing was inevitable, this shows how long that inevitability can be delayed when the right pressure is applied. Short term, expect more chop. Volatility like this doesn't resolve cleanly. It shakes out weak hands and resets expectations. Positions built on leverage get forced out, and positions built on conviction get tested. The difference between the two becomes obvious in moments like this. Long term, the underlying reasons people accumulate silver haven't changed. Monetary instability, currency debasement, geopolitical fractures that make hard assets more relevant, not less. What has changed is the reminder that even assets positioned outside the traditional system are still traded inside one. And that system has levers. The question isn't whether silver recovers. The question is whether you understand what just moved. It and who benefits from that move being misread. Markets don't move this way by accident. They move this way when someone with enough size decides the risk-reward of holding a position no longer justifies the exposure. And when that decision gets made quietly before the price reflects it, you're not watching a market correct, you're watching a market get managed. If you're holding silver, this isn't the time to abandon the position based on a single session, but it's the time to ask whether your thesis accounts for the fact that price discovery in this market is not purely driven by supply and demand. It's driven by positioning, by derivatives, by the infrastructure that sits between physical metal and the price you see on a screen. Understanding that gap is what separates reactive investors from strategic ones. Silver dropped 5% in a matter of hours, and the explanation you're being given doesn't account for what actually moved the market. This wasn't retail panic. This wasn't a reaction to one data point. This was coordinated pressure applied at a specific moment, and understanding how it was executed tells you more about what's coming than any headline will. The drop began during Asian trading hours when liquidity was thinner than usual. Futures contracts were hit first, not spot markets. That sequencing matters because it signals institutional positioning, not organic selling. Volume spiked in derivatives before physical markets even opened in London. Someone was driving price down through leverage, not through actual metal changing hands. The short interest buildup in the week prior was already elevated, meaning the trade was staged before the trigger was pulled. Mainstream analysts pointed to stronger than expected US jobs data as the catalyst. The logic presented was straightforward. Good employment numbers reduce recession fears, which lowers demand for safe havens like silver. But that narrative ignores three things. First, the jobs report had been leaked and front-run for days. Second, silver's industrial demand is tied to economic strength, so strong jobs data should theoretically support it, not crash it. Third, the price collapse happened before the report was even fully digested by global markets, and the timing doesn't align with genuine reaction, it aligns with execution. What you're not being told is that silver had become uncomfortably tight in certain delivery windows. Spreads between near-term and deferred contracts had widened in ways that suggested supply strain, not abundance. When physical tightness exists and paper prices drop sharply, that's not equilibrium, that's suppression. It's a reset designed to shake out speculative length and relieve pressure on those who are structurally short. The question isn't whether this happens, it's who benefits when it does. China's demand patterns shifted quietly in the same window. Imports slowed, but not because of weakening industrial activity. Tariff uncertainties and yuan positioning created hesitation, and that hesitation gave cover for the price move. When the largest physical buyer steps back temporarily, even for non-fundamental reasons, it creates a gap that paper markets can exploit. The yuan's recent volatility wasn't incidental. It was part of the broader environment that made this move possible. Interest rate expectations also played a role, but not in the way being described. The narrative says rising rate expectations hurt silver because it doesn't yield, but silver isn't held for yield. It's held for what it represents when confidence in financial obligations erodes. What actually matters is that higher rates increase the cost of carrying leveraged positions. And silver is one of the most leveraged markets in existence. When carry costs rise, speculative players reduce exposure. That's mechanical, not fundamental. The real pressure point was this: the bullion banks that facilitate the market were caught in a position where both industrial users and investment buyers were pulling in the same direction for the first time in months. Industrial fabricators needed metal for Q2 production. Investment allocators were rotating into hard assets ahead of debt ceiling discussions and quantitative tightening concerns. That convergence of demand doesn't suit entities that profit from managing the spread between paper and physical. A sharp price drop recalibrates that imbalance by forcing weak hands out and allowing repositioning at lower levels. If you're holding physical silver, this changes nothing about why you own it. Your metal didn't disappear, the reasons you acquired it. Systemic debt, currency debasement, supply constraints are still intact. What changed is the price someone else is willing to pay for a contract they may never intend to settle. If you're trading futures or leveraged products, this is a warning that volatility will be used against you. The players moving size aren't gambling, they're managing outcomes. For those looking to add exposure, understand that sharp drops in suppressed assets often precede supply squeezes. When price is driven down artificially while physical demand remains strong, the gap eventually closes, but it doesn't close on a predictable timeline, and it doesn't close gently. The entities that engineered this move will cover their positions quietly, likely during a period of low attention. By the time the next rally begins, the narrative will have shifted again, and the same people who sold you the crash will sell you the recovery. What happens next depends on whether physical tightness reasserts itself faster than paper. Positioning can adapt. If industrial demand stays firm and investment flows resume, the floor gets tested quickly. If macro conditions deteriorate further and liquidity drains from risk assets broadly, silver gets pulled into that vortex regardless of its fundamentals. The difference is that in one scenario, you're early, and the other, you're still early, just on a longer clock. The truth hidden in this move isn't that silver is weak. It's that the infrastructure controlling its price is fragile. And fragility under pressure doesn't resolve quietly. It resolves with breaks. And breaks favor those who understand the difference between what's reported and what's orchestrated. A 5% drawdown in silver doesn't make headlines the way it should. When an asset this strategic moves this hard in 48 hours, the silence from financial media tells you more than the price chart. This wasn't retail panic. This was coordinated exit liquidity dressed up as market correction. The move started late Tuesday, accelerated through Wednesday's London fix, and bottomed Thursday morning, just above $28. Volumes spiked in futures markets during off-peak hours when liquidity is thinnest and slippage is widest. That's not organic selling pressure. That's intentional positioning by participants who understand how derivative structures amplify momentum when stops get triggered in sequence. Large commercial traders increased short positions by 12,000 contracts in the week preceding. The drop, that data sits in commitment of traders reports that most analysts won't reference until it's irrelevant. The pattern repeats every cycle. Accumulate short exposure quietly, trigger a technical breakdown, cover into the panic, then reposition long before sentiment recovers. It's not conspiracy, it's documented strategy executed by entities with balance sheets large enough to move physical and paper markets simultaneously. Silver's supply chain is fundamentally different from other commodities. 70% comes as byproduct from base metal. Mining operations. When copper or zinc prices weaken, silver output contracts regardless of demand. Industrial buyers know this. Strategic reserve managers know this. The entities engineering these drawdowns know this. They're not shorting because they think silver is overvalued. They're creating entry points while retail holders capitulate into manufactured fear. Mining equities dropped harder than spot prices, which confirms this was about shaking out leveraged positions rather than fundamental reassessment. First Majestic fell 9%. Pan American Silver lost 11%. These companies didn't suddenly become less profitable at $28 than they were at $30. Their cost structures didn't change overnight. What changed was the perception of momentum. And in markets driven by derivative exposure, perception becomes self-fulfilling until it doesn't. The 2011 silver collapse followed an identical script. Margin requirements increased on futures exchanges during Asian trading hours. Retail investors woke up to margin calls they couldn't meet. Forced liquidation cascaded through electronic order books, while institutional buyers placed limit orders 15% below market. Within 6 weeks, those same institutions were net long again. The crash wasn't the story. The redistribution was. ETF outflows during this week's decline totaled 400,000 ounces. That's not massive in absolute terms, but it's concentrated among retail accessible funds, while institutional silver trusts saw inflows. Money didn't leave the sector, it moved from weak hands to strong ones. This is how positional advantage gets built when most participants are watching price instead of watching flow. Commodity traders operate on information asymmetries that regulators don't have tools to address, and when a bullion bank desk sees client flow data showing pension funds reducing hedges while sovereign buyers increase physical allocations, that's actionable intelligence unavailable to participants trading on technical patterns alone. The crash created exactly the dislocation needed to acquire size without moving the market against yourself. Gold held relatively stable during silver's decline, which breaks the historical correlation that typically governs precious metals, and when that relationship fractures, it signals something specific is being targeted rather than broad risk-off sentiment hitting the sector. Silver's industrial demand profile makes it vulnerable to narrative shifts around economic slowdown, but inventory levels don't support the bearish thesis being sold. Global stockpiles are at 15-year lows, while solar panel manufacturing and EV component demand continues growing regardless of temporary price weakness. What Wall Street won't publish in client notes is that volatility like this creates the exact conditions for asymmetric positioning. Options markets now price in elevated volatility for the next 90 days, which makes downside protection expensive and upside leverage cheap. That's backwards. If you understand that manufactured crashes in strategically important assets tend to mean revert faster than fundamentally driven declines. The recommended response for mainstream analysts is predictable. Reduce exposure, wait for confirmation, don't catch falling knives. That advice serves the interest of entities who need you selling into their bids. Contrarian positioning doesn't mean blindly buying dips. It means recognizing when price action diverges from underlying supply-demand reality and understanding who benefits from that divergence. This drawdown wasn't about silver's value. It was about testing who understands the difference between price and worth. The entities engineering these moves don't broadcast their intentions through press releases. They broadcast through positioning data that becomes visible only after the opportunity has passed for those who weren't watching. The crash already served its purpose. What happens next depends on who learned the lesson and who are still reacting to headlines.